MSCI recently reported its Q1 2024 earnings, triggering a volatile stock price swing. The stock price went down by 13% right after the earnings, and since then it has recovered by around 9%. Also, MSCI is down 10% year to date and down 22% from its all-time highs. We will analyze MSCI in two parts. Part 1, most recent earnings breakdown. We will go through MSCI's latest financial statements using my own custom-built spreadsheet. This will highlight key data from the income statement, balance sheet, and the cash flow statement. We will then explore various valuation methods, including discount and cash flow analysis, to determine if MSCI is currently undervalued, fairly valued, or overvalued. Part 2, holistic company evaluation. To gain a more comprehensive understanding of MSCI, we will utilize a custom scorecard I developed for valuing businesses. This will involve going through a checklist and answering a series of criteria questions designed to evaluate the moat, revenue, margins, profitability, debt, return to shareholders, valuation, leadership, and the story of the business. First, for those who are not familiar with MSCI, let's take a short look into the company. MSCI stands for Morgan Stanley Capital Investments, although it operates independently now. It is a financial services company that focuses on investment research tools and data for institutional investors like hedge funds and pension funds. 98% of MSCI's revenue is recurring, and the retention rate is above 90% across all products. Their key areas are index, analytics, ESG and climate, and private assets and others. Overall, MSCI helps institutional investors make informed investment decisions through research, data, and analytics tools. Part 1, most recent earnings breakdown. Looking at the income statement, we can see that the revenue for MSCI went up year over year by 15%. The net income went 6.7% year over year, and the net income margin is at around 37.6%. MSCI has reduced their shares outstanding by around 1.2%. The EPS grew by 8% year over year, and the EPS compounded annual growth rate is at 17.6%. Looking at the balance sheet, we can see that the cash grew by 8.7%, and the debt has stayed the same year over year. Looking at the cash flows, we can see that the free cash flow year over year grew by 13.6%. The free cash flow margin is at 40.6%. The free cash flow per share grew by 15% year over year, and the free cash flow per share compounded annual growth rate over the last 5 years is at 19.7%. We will skip the valuation for the moment and come back to it in a second. While going over the recent earnings, I noted that MSCI has slightly beat the EPS and slightly missed on the revenue guidance by around 1%, which is for me basically all in line. Projection for 2024 is a 10% free cash flow growth, which comes around 1.25 billion. I also looked at where does the stock price growth for the past 5 years come, and the stock price has grown 26% over the last 5 years, where the free cash flow has grown by 23% and the price ratio, price to free cash flow expansion, is at 4%. This means that the stock price is growing faster than the free cash flow per share growth, which means that the company is getting more expensive on a price to free cash flow basis. Next, let's look at the discounted cash flow analysis. For the next 5 years, I am projecting a 10% free cash flow growth rate, applying a price ratio of 32, price to free cash flow, and a discount rate of 10%, as well as reduction in shares by 1%. This gives a calculated fair price of $500. When I apply a 10% margin of safety and convert to dollars into euros, I get a 420 euros intrinsic value, or 1% under my calculated intrinsic value. Looking at the overview of all my holdings, we can see that the current stock price of MSCI is $455, or around 8% above my calculated intrinsic value. Looking at the valuation, we can see that the earnings yield, the free cash flow yield, and the free cash flow yield adjusted for stock-based compensation are all at 3.3%. The price to earnings, the price to free cash flow, and the price to free cash flow adjusted to stock-based compensation are all around 30%. We can see that the enterprise value is higher than the market cap by 4 billion. If we take a look at it in a visual way, we can see here the price ratios, and my favorite ratio is the enterprise value to free cash flow. This is because the enterprise value factors out the cash and the debt that the company has. And if we look here, we see that the MSCI has 4.5 billion in debt and $500 million in cash. Therefore, that's a delta of 4. And the market cap plus debt minus cash is at 39 billion. This is one of the things that I don't like about this business. I don't like when the enterprise value is higher than the market cap. However, in this case, the debt is at 4.5 billion on a market cap of 35 billion. That is not that big of a percentage. Part 2, Holistic Company Evaluation. In order for this video not to be too long, I have published this part on my Patreon. My Patreon members get exclusive access to my own custom-built tools such as stock analysis tools, designed for earnings, various company valuation tools, complete research on my current holdings, best ideas watchlist including full analysis, past research stocks, also full analysis, personal portfolio buys and sells, template for analyzing businesses, personal budgeting tool called the JAR system, multi-year budget tracking tool, network tracking tool, Q&A sessions, and one-on-one sessions. I have put a lot of effort into developing all these tools you see, and I think they will provide all of you with much value. You can try it for a month, and if you don't like it, you can cancel anytime. If you do not want to join the Patreon, you can also buy any of the tools with one-time payment. This will only be a snapshot of the current tool and obviously will not contain future updates. Your support directly helps me create the content you see here. Link to the Patreon is in the pinned comment below. Anyways, that was my analysis of MSCI. Now, before you run off and invest your hard-earned money, remember that this video is for informational purposes only and it does not constitute financial advice. Do yourself a favor and conduct your own research before making any investment decisions. Finally, don't forget to leave a like on this video, consider subscribing to the channel, and leave me a comment suggesting a company that I should review next. Cheers!